Okay, this is just our standard disclaimer. Very important. Just keep in mind that the information presented here today from all of us is informational only. It's not advice specific to your situation, so take it with a grain of salt. All investments have risks. So today I'm going to be mostly covering small caps and a specific opportunity that we're seeing play out there at the moment. So we're calling this the small cap divergence. Mathan actually covered a lot of this, the setup for this slide already, so it shouldn't be too much work for me. But basically, as he mentioned, interest rates and inflation are key drivers for the markets at all times. They're the fundamental driver, really, interest rates. Recently, since the COVID situation, there has been a particular theme playing out where interest rates and inflations have been moving quite a lot, and that's had some very particular impacts in the markets. So one of the key points with interest rates is that they impact the risk-free rate. And so essentially, with any investment that we make, we have to benchmark that investment against every other investment. No investment happens in isolation, and the easiest way to do that is with the risk-free rate. Now, essentially, that is usually the 10-year government bond. So that is the investment that has the lowest risk, and so we look at the yield that you can get from that bond. If you were thinking about that as an individual, you might think about a high-interest savings account or a term deposit as being something similar. The place where you can put your money, what return you can get at the lowest possible risk. So the impact of the risk-free rate is that at the end of 2020, we had the government 10-year bond at about 1% yield. At that point in time, if you were looking at receiving $1 in profit in 10 years' time, it would have been worth about 90.5 cents in today's money. At the end of 2023, that same Australian 10-year government bond was at a 4% yield. At that point in time, $1 in 10 years' time was worth about 67.5 cents. So we can see that there's quite a dramatic impact on the value of money today versus the value of money in the future based on where interest rates are. So I know that's pretty dry, but it's important to set up what we're about to look at. So as you know, at the end of last year, big caps got quite a bit of momentum, and they're starting to look much more fully priced, again, as Mathan covered. But at the moment, there's signs that interest rates have peaked. As Mathan said, hopefully going down at the end of this year, possibly not before that though. But what we have here is a chart of the implied forward rate path for Australian interest rates. So this is the bond market essentially telling us what interest rates are going to do over the next 18 months. And as you can see, they're expected to fall. So these expectations do change over time, but this is how it's currently viewed at the moment. So this would be the first move back from our peak interest rates. So I'll just go through a few charts to highlight what we're looking at with the small cap, large cap divergence. So this is the 4 big stock market indices in the US. Right at the top there in orange is the NASDAQ. Down from that, we've got the S&P 500. Right at the bottom in the pale aqua is the Russell 2000. Now the Russell 2000 is the small cap index. So you can see there that the NASDAQ and the S&P 500 have well and truly outperformed the small caps with the Russell 2000. I'll just draw your attention to the left-hand side of the chart. Early on, post-COVID, when interest rates got slammed right down, that small cap index actually went up harder than anything else. So it was keeping pace with the big caps, and it was outperforming the S&P 500. So what's happened as interest rates have gone up? The riskier end of the market has suffered, and those small caps have not kept pace. So that divergence has been playing out recently while those interest rates are going up. And this slide, basically the same thing, but what we're looking at here is the Australian market. You can see the COVID crash there on the left. The blue line there is the S&P 200, so it's the top 200 companies in Australia. Now the orange line is the small ordinaries, and that is the 200 to 300 companies. So it's essentially the top 300 minus the top 100. So again, we're looking at the big caps in blue and the small caps in orange. Again, interest rates, when they went right down, we had a big move up in the small caps. They actually outperformed. That's because everyone's jumping on what's risky. Bitcoin went up, everything went up that was risky, essentially, because we're looking at that value of money in the future, and we're saying that that is worth more at that point in time. Interest rates go up, then what happens? Value of money in the future, not worth as much. So growth and risk stocks don't perform so well. Okay, this is a little bit tricky, so please bear with me. The yellow line there is the US 5 years. So that's the 5-year government bond. Now, the blue line is the Russell 2000 divided by the S&P 500. So that's the ratio of the small caps over the big caps. That's one way of looking at it. So as those interest rates started to go up, essentially, as the bond's falling, interest rates going up, that put downward pressure on that relationship, as we've already seen. So I just wanted to highlight that in a slightly different way. As you can see there, that 5-year is basically going sideways now. Now you can look at that with the 10 years, you can look at that with the euro dollars or any other interest rate product. It's going to be very similar. Now this is for the Australian market. So a little bit different again, just to keep things interesting. So the yellow line there is the curve, and that is the Aussie 3-year bonds minus the Aussie 10-year bonds. And that's a very important metric to look at in the Australian bond market. It basically tells us what the expectation is for interest rates going forward. I will just bring your attention to the kind of peak in the middle there of the orange line. That, where it kind of gets pinned at the highs there, that's actually when the government put a price target on the 2 to 3 year bond. So essentially the bond couldn't move at that point. The blue line there is again the ratio of the small caps over the big caps. So in this case, the small ordinaries divided by the S&P 200. So I've widened this one out a little bit so we get a little bit more data, but you can see the COVID crash on the left. There's a little bit of manipulation and funny business, but essentially as that expectation of interest rates going up was occurring, there was a delay, and then after a little while we saw that relationship between small caps to big caps take a hit. If you look at that chart, there is a few places where the curve is leading that relationship, so it's a leading indicator. And what we're seeing on the right-hand side there is the curve has started to turn back up, so the expectation of interest rates going down has started to occur, and the small caps are still underperforming, so we're getting that lag, and this is what we're seeing as the opportunity at the moment. So that's all very well and good, but then we have to get into how do we pick the particular stocks. Okay, so this is an old slide of ours. It goes into a process or a due diligence list in what to look for small caps in particular. There are specific risks with picking small caps. I want to focus on 3 of those that we think are very important today. So the first of those 3 risks is funding. So small caps typically have a harder time raising money. They typically run a bit leaner. Quite often, they're not profitable yet when we're getting into them. In the current interest rate environment, where people have been a little bit more risk averse, banks are less willing to lend money, people are getting squeezed in terms of not having as much discretionary cash. So it's been a tougher market in which to raise capital. We've seen a dramatic downturn in the number of IPOs that are hitting the market as well. So endless capital raisings, when they occur with small caps, they can demoralize shareholders, they can destroy value, they can dilute the share price, and they can also force those small companies into bad deals with predatory lenders. If you've had some small caps that have gone through some tough times, you may know some of those lenders. They're the same old faces that pop up and kind of strip the value out of those companies. So it's important to understand whether or not these companies can reach their goals, reach their cash flow, their revenue, their product launch, whatever it is, with their current cash levels. The next thing that we want to look at is management team. It's picking a management team, whether they're good or not, particularly with small caps, can be one of the toughest jobs as an analyst. It can be very hard to know if someone's going to be a good leader, if a team is fully fledged out, all that kind of stuff, to cover all the bases. One way we can do that is by looking at alignment to shareholders. Elon Musk, we all know who he is. In the early days of Tesla, Elon did not take a salary. He took only stock options. So he is 100% aligned with what shareholders want, essentially. So if shareholders make money, he makes money. So that's a really good sign that he's both committed and incentivized, and that he believes in the company as well. Track record can be a little bit tougher. So with Elon, for example, had a great track record with PayPal. Is that actually transferable to like creating a car company? That's a big risk. And I'm sure in hindsight, it's very easy to say, well, obviously, he's great at everything he does. But we didn't know that at the time. So with hindsight, everything's easy. But that is one of those kind of risks that we have to take into account, whether skills are transferable, whether a team is well-rounded, that kind of stuff. Now, the last thing that we really want to focus on is that a small cap has to have a growth story. We don't get into small caps for them to stay small. Otherwise, we would just pick a good big cap. We're getting into it because we want to see that it can make money, it can grow, and it can grow. So we want them to eventually become big caps. So we want to look at what their potential is, what the evidence is that they have growth, and then also things like patents, product launches, how big their total addressable market is, that kind of stuff. So with that in mind, we're just going to have a look at a few small caps. So the first one, Hillgrove Resources, the ticker code is HGO. They are a copper miner. And they're about to begin production early this year. Any moment now, they're beginning production. They're already mining. They're about 170 million market cap at the moment. So again, Mathan touched on a lot of this. He did my job for me, so that's awesome. I can kind of skip over a bit of this. He mentioned copper's in everything. This is one of the reasons we love this stock. There's the big growth story with EVs, solar panels, anything electrical really has copper in it. It's also getting harder and harder to find copper. We're having to drill deeper to get to it. Grades are getting smaller. So with so that's the, I'll just go back for a second, sorry. So that's the growth story of the market they're in, I guess. And so again, looking at these stocks, I'm just going to try to mention growth, management, and funding as well. So one of the reasons that we really liked HGO was that they were already funded through to production when we first recommended them. At the moment, they're already mining and stockpiling in preparation for producing copper. So they've got a very clear path to revenue. I think their recent quarterly, they still had $10 million in cash. And they've got that production coming any moment now. So that removes a lot of that risk around the funding situation. So again, with funding, these guys have no debt. The internal rates of return are looking quite promising, all of those metrics. The project is a fairly low cost one to get started. So we were talking about maybe $30 million. A few other things from this slide, just on that growth story again, they've got a lot of drilling and mine development potential as well. So they've got about 6,000 square kilometers of tenements that they can continue to explore. The grades that they're sitting on so far look pretty nice. There's some gold potential in there as well. As we can see here, share price has been volatile. So if you like to get in and out, there's certainly been plenty of opportunities there. It's done well since we recommended it, and we've had a bit of a pullback there recently. In terms of that management alignment, I don't have it on the slides here, but the CEO owns about 1.1%. He's been with the company for over 10 years. So he's had a key job in bringing this all to fruition so far. And we think he's demonstrated a really strong ability. So we've got a lot of faith in him as well. So the next one I'll jump on to, sorry I'm flying a little bit, but I'm just conscious of time. Next one we've got is Camplify, CHL. Now Camplify, they're a small company, 158 million market cap. They're disrupting an old and stagnant industry in a way, which is RV rentals. So that's might be a little bit hard to see. I'm not sure if you guys can see that very well. But essentially that's a world map, and we've got the locations where they're currently operating. So they're essentially trying to be the Airbnb for motorhomes. So with motorhomes, most people who have an RV, a camper van or a motorhome, they use it for about 20 days a year. So most of the time it just sits on their front lawn or in the backyard or whatever and collects dust. And that's quite a lot of money that you could consider as just sitting unused most of the time. So where Airbnb took spare rooms and used them to disrupt hotels, what Camplify is trying to do is take people's RV when it's just sitting in their backyard and rent it out to someone else to use, someone who's on holidays. So one of the things with this company is, we'll get onto the growth in a second, but they've demonstrated really strong growth already. As part of the COVID reopening story, they've seemed to have done quite well. So it plays into that travel theme as we're reopening. And the other benefit is that maybe after COVID, you don't want to be in hotels with other humans. You want something that has a quick escape potential, so an RV is perfect. And here's the growth. So the growth with this company is demonstrated. They've already shown that they're growing quite strongly. You can see those numbers there with New Zealand, 12,053% growth on the total volumes that they're handling. So essentially, they just take a piece of every deal that gets made through their platform. They've also expanded overseas. So they've just recently bought Paul Camper, which is a big company in Germany doing essentially the same thing. And they're expanding into insurance as well with a product called My Way. So they're expanding both in terms of jurisdictions and in terms of products as well. Europe for this company is the big prize. Europe is a big RV market, so it's a very big opportunity for them. I mentioned before that 20 days per year in Europe where, on average, that RVs are used, the private RVs, that is. But at the same time, they're experiencing a 20% growth per year in RV registrations. So there's a lot of potential there. So the focus of Camplify is to get more RVs onto their platform. They have well and truly enough demand in terms of people looking to rent an RV, so that's not the problem. The problem is getting the RVs on there. So we've already seen big increases in revenue, and at the same time, they've increased in the last 12 months the number of RVs coming onto the platform quite dramatically as well. I think it's up 186% from memory. And so that is future earnings potential that's coming online. Again, with the growth story. So this is demonstrated growth. On the left there, we've got revenue. As you can see, it's starting to get a little bit exponential. And then on the right, we've got their gross profit. So might be a little bit faint. I hope you all can see this, but essentially one of the big issues with RVs is that the demand is seasonal, particularly if you're somewhere that's very, very cold. So one of the great things about having businesses in New Zealand and in Europe is that they can stabilize and smooth out that cash flow. So it's not just one big lump at one time of year. They get to offset the seasonality. Then they get, as I mentioned, better cash flow. They can use their capital in the different markets as it's required. Talking about the growth opportunity still. We've shown the demonstrated growth. Now this is what they can potentially achieve. So at the moment, they've got less than 1% share of their market. New Zealand, they've got the highest share at 2.6%. So you can see that it's not crazy for them to get like 10 or 20 times their current earnings. They've got that room to grow. So we could see that in the next 3 to 5 years. The company could go bankrupt. Who knows? There's always risks, but the opportunity is obvious. Their current gross margins are at about 68%, so that's also quite healthy. And we would expect their fixed costs to stay quite low as they grow as well because they're an online platform. They will definitely have more marketing spend as they try to get out in front of people, but we would expect that fixed cost as a percentage to fall. So in terms of funding, the company's already cash flow positive. So that's a massive, massive boost in terms of reducing that risk. It's a big milestone for most small speculative stocks to get to that cash flow positive state. So there's a lot of risk removed. It also demonstrates that their business model can work. So they're still growing, they're cash flow positive. This is obviously working, something's working here. They also expect to be profitable this year in FY24. And that could be a big catalyst for the stock to get some attention, to get a re-rating. They've got $26 million in cash. So funding is not a very big risk for them at the moment. Looking at the chart, it's starting to look a little bit bullish, although we did have a bit of a pullback. So as I mentioned, those catalysts, that potential profitability and continued growth in revenue, if we see more revenue numbers coming out bigger and bigger, and that's going to be big catalysts. In terms of the management, I will just touch on this quickly. Founder-led business, Justin Hales, still in the CEO role, and he's got about 7.8% of the company. He's delivered all the growth that we've seen today, up to date, so we've got a lot of belief in him, and he's strongly aligned to shareholders. Okay, one of my favorites, PIQ, Proteomics International Laboratories. They're about $130 million market cap. Now, proteomics is the study of blood proteins, and it's a relatively new, in terms of science, field of study. So Proteomics has a platform called ProMarker, which is used for identifying diseases and conditions by looking at the proteins that are found in the blood, and in particular, the combinations of proteins. They call these biomarkers and the way they combine fingerprints just to highlight how unique they are. So they're very good at predicting what's going on with someone just by looking at those proteins and the specific combinations. So they've got some specific tests as well. So that's a general platform, but then they've got specific tests in ProMarker D, ProMarker Endo, ProMarker ESO. These are just the first three, the ones that we really want to focus on that are happening this year, but they've got a lot more in the pipeline as well. The companies also, they do some lab work for other companies, like outsourced lab work to help offset the cash burn. They just did a pretty small institutional capital raise, which should see them through for the next couple of years as well. So funding is not a major concern at this point, particularly because they've got their first test being commercialized this year, and that's ProMarker D. So for people with diabetes, ProMarker D can predict the onset of diabetic kidney disease up to 4 years in advance. This is a really big deal because the current tests can only identify diabetic kidney disease once damage is already happening to someone's kidneys, and that damage is irreversible. So it's really important that this can be caught early on. The other thing that it's really helpful for is that if there's early signs that this disease is coming on, doctors can then react and put treatment plans in place, lifestyle changes. Not only that, but then they can monitor the impact of those changes by what happens with the test going forward. So they can continue testing to see what's working, what's not working. They're through their regulatory barriers for entry, so they're open to start selling. In terms of the opportunity, the company just received Medicare and Medicaid rebate at $390 US. This covers about 42% of the population in the US. There's about 30 million people in the US with diabetes, so that's roughly a $12.5 billion market. They're entering the market with a licensing deal with a company called Sonic Healthcare, SHL. So PIQ is expected to get about 10%, so that's roughly about $1.9 billion a year for the total market in the US. That would be mostly profit because it's a licensing deal. They don't have to supply anything to get that money. I mentioned earlier, the company's current market cap is about $130 million. So 1.9 billion, obviously quite a big opportunity. Remember, there's no comparable tests. 42% of patients already covered by Medicare and Medicaid. So when they go and get it, they don't have to pay anything out of their own pocket. So even at like a 20% market share, they could be looking at $380 million per year, which is about 3 times their current total market cap in profit every year. A growing biotech can easily be priced at 30 to 50 times their earnings. So it's easy to see how there is the potential for this to be a 100x return kind of opportunity. I'm not saying that's definitely going to happen, but this is just the first test and just the first market as well. The company is very active in rolling out their test globally, so they're commercializing in a number of different regions, and they're taking different approaches with different companies depending on their expertise. So some are licensing deals, some are just distribution deals. In terms of the catalysts, this year coming up, we've got those first sales from ProMarket D, and we've also got clinical trial data expected from the endo and the ESO, that's endometriosis and esophageal cancer. Endometriosis affects about 1 in 9 women. It's extremely painful, takes about 7.5 years to diagnose, and surgery is required to diagnose it. So a simple blood test to diagnose it, and then potentially surgery for a follow-up in the women that it does diagnose is a really good solution. So that's a really good opportunity there as well. As we can see, the share price has been volatile, but fairly range-bound. The market at the moment doesn't seem to be really believing that this revenue is going to hit. It's a we'll see it when we believe it kind of thing. It's very hard to find a biotech or pharmaceutical company at this stage that's valued at like less than $300 million. There's plenty of companies that are pre-phase 3 trials or in phase 3 trials that could be valued at 700 million or more. So they look well and truly undervalued by our reckoning. So lastly, just a little bit of something, an idea to leave you guys with, a potential return to retail. So retail has been looking pretty tough recently. Retail sales numbers have come in quite poor. The retailers themselves not looking too terrible on average. But the point that we wanted to get to is we've got these tax cuts coming through. The government's been revamping the tax cuts, the stage 3 tax cuts. So we're going to see more money into the pocket of the middle class. What are they going to do with that money? They're probably going to buy TVs and couches. I don't know, just a guess. So that's great news for retailers. One we just wanted to highlight here is Nick Scali, $1 billion market cap, furniture retailer with a really great track record. Current CEO is the founder or the founder's son, but he's been running the company since IPO. He's got an 8% stake. He's led the company to a 10x return already. I might have just covered all of that. They've got great margins. That's the other thing I just wanted to mention. About 68%, or no, sorry, 62, 63% from memory, but well and truly above that 60%. It's amazing for a retailer. They've just acquired Plush. They're expanding rapidly still. 6% trailing dividend as well. Just the financial metrics, very strong. Last update that came out showed a little bit of softness in their results. There could be a little bit of an opportunity in the next half-year report. We might see the market react and sell. They might sell off a little bit. That's what we're basically looking for. This short-term softness, is there a pullback? Can we get in on that pullback? For us, this is the kind of stock we want to hold for 10 years. We think Scali is a really great company. They've got great management. Everything they do is great. Love them. So we're just looking for those pullback opportunities. So, not to ruin everyone's day, but this is a chart of Westpac, a little bit cheeky, but the point here is that Westpac has gone sideways for the last 10 years. Obviously, you would have still made pretty good dividends, so it's not the end of the world. But if you're looking for something to grow, it wasn't Westpac. Scali, 10x return, plus healthy dividends. I'm just going to be cruel now and put them side by side. But there you go. So nothing wrong with Westpac, but don't confuse volatility with risk. Scali, great business still. If they have that pullback, if the tax cuts flow through and they get a boost in the later half of the year or maybe next year, there could be a great buying opportunity with Scali. That's basically my time. So thank you very much, and I hope you enjoy the rest of your day.
With today, let's get on to the next sort of slide. But I know most investors want to hold a stock for the long term, and they want very good dividends in regards to their overall returns. I'm not the best with technology as such. So with many investors, you want a good dividend. I know that always helps with their overall returns. And I'm certain everyone here likes their dividends. Is that correct? Yep, good to hear. Now, with that being said, too many investors focus only on the dividend yield. And of course, the dividend yield you can find on your trading platform. It shows you the percentage of that share, assuming that you get that share at today's price. But there's some big problems just focusing on that exact number, because on all share percentages, it relates to last year's profits. It doesn't necessarily mean that the company will make the same profits next year. And that's where so many investors get caught up on that dividend yield. Now, with that being said, right, you've got to make sure that the business is growing so that whatever profits they made last year likely will be bigger next year. And of course, then they'll pay bigger dividend checks. Now, to give you a quick little example, I'll run through this very quickly for you. There's a company A, I'll call it. I won't give you the code right this second. Right? It has a $100 billion market cap. It's a big company, pays about a 6.3% dividend return, plus franking credits. And then there's a second company, which is only a $2 billion company, so still not small, nice company, been in business for years, and only pays under a 3% dividend return. I would like a show of hands with that basic information. How many people would more focus on the 6% plus dividend return compared to a company which only pays around 3%? Quite a lot of you are focusing on the 6%? Exactly. Now, with this company, if you invested $30,000 approximately on that 6% plus range, you're going to be getting a dividend check of approximately $1,900. And all of us like $1,900 coming in per year on 30 grand. However, with company B, it only is paying $900 in dividend check. And I'm certain everyone wants the extra $1,000. Now, just with that, right, company A is a big bank. I'm not going to tell you the company, but all of those figures and numbers I gave you was 10 years ago. That was the price, right? Fast forward to today, that same big bank still paying 6% return on their money, right? But the share price has dropped because the business is not growing. So the 6% you're getting is now only earning you approximately $1,400 in the bank, right? And in the last 10 years, inflation has grown by 30% here in Australia. So as we know, $1,900 10 years ago bought you whatever, so many loaves of bread. Fast forward to today, you're not buying as many loaves of bread for $1,900, let alone only $1,400. Now, company B, I'm going to tell you about at the end of the presentation today, right? But as that company has steadily grown its business, it's always only paid about 3% dividend return on the share price, but the price or the dividend per share has grown every single year, and you're now earning a bigger dividend check in your bank account than that big bank, which I'm certain everyone wants more money in their bank every year. Is that correct? Yes. So just keep in mind long term, you want a growing business that is growing their dividends, right? And of course, everyone likes capital growth on top. So the first stock everyone should put high on their list to strongly consider is the Charter Hall Group. Please be very careful about the ticker code. The ticker code is CHC. This is the head company, right? Now, Charter Hall Group is a diversified real estate play which also manages funds. Now, many people don't think that a business which is in real estate has a very good return on its invested capital, right? A lot of real estate plays are expensive to capital and they only get a small return on the money coming in through rents. But Charter Hall Group pivoted themselves very, very nicely quite a few years ago to now be a massive funds under management business. And when I'm talking about funds under management, I'm talking superannuation funds, sovereign wealth funds from overseas, who are wanting to invest a lot of money into the Australian property market. Now, with all properties, you'll see on the slide here a breakup, right? There is, if I can get the little pointer, maybe not, but office space is around a third of their business, right? In the industrial and logistics estates, I'm certain you've seen all these big warehouses popping up everywhere where all the big semi-trucks come in and unload all the goods from the ports. They have around 28% of their business in that. They've also got retail stores and they've got some very good social impact areas as well. So in a nutshell, Charter Hall Group is diversified across all real estate sectors in the market. And what is so good about Charter Hall Group is they have over 97% of their places all occupied. And what is very important is the second point, their top 20 clients, right, are all big multinational type businesses and the Australian government. And they have over half of their income coming from A-grade quality clients, which I'm certain many of you have real estate properties or commercial properties. The tenant is just as important as the location. Now, with this being said, Charter Hall Group has a 7.5-year weighted average lease on all of their properties. But the one thing which has scared the market, and this is where we see Charter Hall Group now as being an undervalued stock for you guys to consider, is the office space. I'm not trying to beat around the bush. There is all this talk about Work from home, office space rents are dropping. Look, it is there, it is definitely happening, but with Charter Hall Group, you've got to remember with all property plays, the good old saying, location, location, location is the most important thing. Exactly with Charter Hall Group. All their locations of their properties are top notch. They're all been roughly built in the last 10 years, and they also all have very high ESG standards for all these big corporations who are trying to report on their ESG ratings. So with that being said, Charter Hall Group, even on the property division, has 93% office space leased, well above the market average of 85%. Now, some of the tenants, just so you know, besides the Australian government, which makes up about a quarter of their income, is Wesfarmers, there is also Coles, there's Woolworths, there's Telstra, right? They're some of their best clients, and of course, all those companies are going to be here for the next 10, 20, 30 years. So what's most important, though, is the other parts of Charter Hall Group, which is their funds under management section. They are growing this business very, very nicely. Last year alone, they grew by $7.5 billion more in their funds under management section. And with all this funds under management money, because it is in real estate plays, there's very strict terms and conditions on the investors, be it the superannuation fund, be it the high net worth individuals. They generally can't pull those funds out for a minimum of 5 years. On average, it's about 7 years. So don't panic that the funds might get pulled out of the Charter Hall Group. Now, with this, the best thing is the dividend and how it grows every single year, right? The dividend yield is approximately 4.1%. Nothing bad, nothing great, right? But it grows every single year by approximately 6%. So again, just with some numbers, let's say you got a $1,000 dividend check last year. Next year, you can pretty much bank on, you're going to get 1,060. The year after, 1,150, which, as we all know, inflation is running at about 5-6% at the moment in Australia. This is at least keeping up with inflation. Now, what is good is right now is the valuations. What is key with Charter Hall Group compared to many other companies on the Australian Stock Exchange, excluding the miners and the banks, just so you know, the overall ASX 200 has a forward earnings multiplier of approximately 22. So most prices are at 22 times future earnings. Charter Hall Group is only at 14, well below market averages. And we do see that the guidance which Charter Hall Group has done is actually very, very conservative. They have not properly assumed long-term averages with their management fees they earn and bonus fees from all of these funds. If we take that into account with long-term multiples, they're actually trading currently on a forward earnings multiple of only 10, right? So there's some extra upside potential is what I'm just trying to say with this reporting season for the next 12 months. It could do a lot better than even management has provided the market. So I strongly suggest you all have a look at Charter Hall Group, and compared to the high, which was back in 2021, where the price was in the mid-25 level, right? Currently trading at around $12, pays a good dividend, and the one big benefit which no one knows when it's exactly going to happen is when interest rates do start to drop, right? Of course, Charter Hall Group will have an extra benefit there because of the cost of borrowings they have, right? So how many people already own Charter Hall Group at the moment? CHC? Well, quite a few of you. Well, you're on a very good one there, right? So right now we do like it. But here's the next one. And this was stock B, by the way, in that first example I gave you, right? Now, with Brickworks, I'll say it at the start, put it on your watch list. It's not a screaming buy at the moment, right? And that's not because it's a bad company. We believe that there's going to be a better price to pay for this share down the track. Now, Brickworks, ticker code is BKW. What is so interesting about this company, there is a lot to talk about. I can talk about this company for an hour in itself, but there is pretty much 4 major parts to this business. And owning the one share, you actually get a very diversified portfolio, which I'll explain about now. So, the first part of Brickworks, yes, it is a bricks and tiles business, right? That's where the name comes from, but that is the smallest part of the actual business. Now, there's all this talk about building approvals being a little bit low at the moment, but fundamentally long term, Australia needs more houses. I'm certain there's going to be more demand for bricks and tiles, right? But coming to the investment side, one of their major investments is in WH Soul Patterson's, not the chemist. It's actually Australia's second oldest company on the Australian Stock Exchange. The ticker code is SOL. Brickworks owns 26% of that company. Now, what Soul Patts is almost like Macquarie Group, a big investment company which invests in 1,000,001 shares, be it listed or unlisted, but doesn't have the banking part, if that makes sense, right? Now, what is a little bit interesting, the largest shareholding of Macquarie Group, the bank, is actually Washington Soul Patts, just so you know. And I believe many of you in the room probably have Macquarie Group in your portfolio. I see a few heads shaking, which is good. The next part of what Brickworks is not known for, and this is the key part to this business, is the big joint venture they have done with the Goodman Group, right? Now, just a bit of long story made awfully quick. Brickworks, they buy a quarry on the fringes of the cities. They use the quarry for their bricks and tiles business. The city grows. Next minute, that quarry is in the middle of the city or on the fringes as such. They then go and do a joint venture with the Goodman Group to convert that quarry into industrial estates, i.e. the big warehousing for distribution. This is the biggest part of Brickworks. And again, they have tenants very similar to Charter Hall Group, being it Amazon, be it Woolworths, be it Coles, for all their mass distribution around Australia. So now, what is so nice about this is their steady income they are getting. 70% of their profits come from the leases to Woolworths, Coles and Amazon, right? 20% of their investments, of course, they've got the stake in good old Soul Patts, which I mentioned. Here is where we see it is on the watch list. We did advise many members at Shares in Value to pick this up about 18 months ago when it was around $19 a share. Fast forward to today, it's around $28, $29 a share, just depending on the day of the week. Now, with existing leases, all of their leases have a rent review besides inflation kicking in. We have worked out that currently the rents on most of their properties in this area, they're getting about $148 million coming in. It should be about $225 million on today's prices, right? So the revenues of the rent for Brickworks will likely be growing over the next 1 to 2 years by 50%. They also have big new pipeline of industrial estates happening. They're going to be adding about 140,000 metres squared of new space. Now, with that all being said, the dividends, which I'm certain you all like, right? Brickworks never cut its dividends in over 47 years. It has the best track record on the ASX. Every single year they have grown it. And then second best, just so you know, is what they own 26% of, Soul Patts, at about 35 years. Now, what always turns off many investors with Brickworks is the dividend yield. As I said, it's normally about 3%, right? Fully franked. What many people don't realise is they only pay out approximately 30% of the profits as dividends. The remaining 70% is reinvested in the business to grow the business, to increase the revenues, to increase the profits next year. So with Brickworks basically withholding 70% of the profits, you could almost think of this as an automatic dividend reinvestment plan, which I think quite a few of you will have some dividend reinvestment plans in place. Now, with the chart, here it says Brickworks compared to the ASX 200, just giving you all 200 stocks, has dramatically outperformed the market, be it on 1 year, 3 years, 5 years, 10 years, be it 20 years. It is a very, very well-known stock. So, as I mentioned at the start of the talk, right now, great to give you this information. There might be a better buying opportunity down the track. So next time Shares in Value tells you to buy this stock, I strongly recommend you find your pennies and your pounds hidden away and buy this, because you'll definitely not regret it down the track. And with the overall share price, as you can see, it's bounced up and down in the short term with the overall market volatility. And as I mentioned a second ago, it's currently trading at about $28 a share. Now, just to give you the end little numbers, which I wrote down here, that big bank, as I mentioned 10 years ago, if you bought the $30,000 worth, it now, including the value of your shares and the dividends, has netted you a total worth of just under $39,000 in 10 years. So that works out to be approximately 6% compounded year on year, right? Okay, not bad. Nothing. We're not trying to badmouth out the banks. We're just trying to give you some new ideas. But when you compare that with good old Brickworks, your actual return, sorry, I've got so many pieces of paper here. I don't want to tell the wrong stat. Your $30,000 is now worth just over $72,000, right? So as you can see, over 10 years, that 70% being withheld, reinvested in the business to grow it, right? I'm certain everyone would much rather to have $72,000 worth, be it in the share, be it in the bank, compared to only $38,000. Yes. So with Brickworks, just as a show of hands, do as many clients own Brickworks at the moment? I can see a fair few in the back, a few in the front. No wonder you've got nice big smiles on your face. You've got to be very, very happy. Is it your shout at the bar afterwards? No. So look, thank you for attending today, and thank you for listening to myself, Isaac and Nathan. Right, I look forward to having a chat with you all a little bit afterwards today, but I'll get Rixon back up here because she knows the routine. So thank you, everyone.
So I have worked around the world. I have worked in broking, funds management, tech, predominantly in fintech. So there's a lot of areas that have been covered. So I'm a data geek at the end of the day, so there'll be a lot of data. So I'll walk you through a lot of data, give you an idea of things, where we are, big picture things, long-term things. And it's all about the cycles. Because at the end of the day, the cycles determine where you should be, what you should be looking at, where the growth is going to be. So you're looking for structural things that are going to work in your favor. What comes in fashion, what goes out of fashion, things happen very quickly. So the structural cycles, they're key. One be. So it's a bit like, investing is like, it's like a jungle. You're there, you're all trying to get your feet, you're trying to go for the water. There's always going to be risk. There's always a predator around. There's always things that happen on the side. You just have to manage your risk through the cycle. So if you understand the overall cycle, you're generally going to be in the right end of things. So I'll just walk through that. This is one of my favorite charts. There's 200 years of this chart. So this is the US bond yield cycle. Why it's important? Because bond yield, the bond market, pretty much determines everything because it's your cost of borrowing. Whether you go for a mortgage, whether you're trying to buy equities, everything is related to the cost of borrowing. And as you can see, we have these dramatic cycles. So over the last 200 years, from 1800s, actually it's pretty much around the World War II, bond yields were on a downwards trend. You had a few bounces, but it's generally a downward trend. Now, this is where the saying comes, buy and hold strategy. So if you buy any asset and you hold it, and the cost of borrowing is going down, the value of the asset goes up. That's your basic equation. So, all my parents, generation, and before them, they all did well because of that reason. I'll show you that. So, what happened after the 1950s? We had the World War II. We had the inflation side. The inflation picked up. Interest rate, bond yields all rose. For the next 40 odd years, it went up. Now that's a tough time to hold assets. So you had to trade assets during that time. Because markets get excited, they're pricing the future, cost of borrowing goes up, people get into trouble. This is the general cycle. So people are not used to that kind of cycle because from 1980 to basically 40 years, we had the falling one yield cycle. It's the cost of borrowing. So if you bought houses in the last 40 years, you killed it. If you bought any asset in the last 40 years, generally you kill it. Because it's just a matter of cost of borrowing. So that's the main cycle. Now, when the bond yields get to zero, well, it's pretty hard to go below that. I know that Japan has tried to do it a few times. It kind of helps when nobody else is doing that. Now, everyone is gone down to the zero. And generally what happens there is because the production cannot keep up with supply. So the demand cannot be matched by the supply. And then you get inflation. And then you get the yield cycle turning. So we've had the yields bounce up because interest rates are going up with inflation. Now that does not happen for a year or two. It really happens. So once that cycle breaks, the supply can never keep up with demand. So you get these inflation cycles and cost of borrowing goes up, and that generally goes on for a long period of time. So we are potentially in a cycle where cost of borrowing will remain higher for longer. So what we've had in the last 10 years, very unlikely to happen in the next 10. Now, the investing, this is where it gets tricky. Because unless you were investing before the 70s and 80s, you never had an environment where rates actually go up consistently or remain high. And inflation remains relatively competitive. So this is why it becomes interesting. So to break that down a bit further, you can see the blue line. From the 80s to 2020, straight line down. Basically, US bond yields basically set the cost of borrowing globally. So if you were in that, it didn't matter what asset you bought, as long as you just keep buying. So people leverage and leverage and leverage because it just makes sense. Because your cost of borrowing is always falling. Still it didn't. And you get these blips like the GFC happened, and we don't But the trick is, as you can see historically, once you have the inflation bounce like we've had in the last couple of years, then you create the environment where inflation is going to remain relatively elevated. So it's very hard for you to go back to the norm. You never have cycles where it pops and then goes back to flat. Now, once the cycle breaks, you have a period where inflation will remain elevated, bond yields will remain elevated before the cycle returns, and then you get the other side. So right now, we've had 40 years down, and we need to get ready for the next at least a decade. The core, I'm doing a lot of the data on US because at the end of the day, for equity markets, US is what counts. What they do matters to everyone. It's global currency, and what they said on interest rates will fall on to us. If the Fed raises, we will raise. If the Fed cuts, we will. So generally, it's all linked to the US economy. Now, if you look at core inflation versus headline inflation in the US, you can see what happened in the 70s. And you can see that you had the first bounce, then it came back, and the core started to flatten. And the headline goes lower, and then it bounced back. Now that's the worry that we have right now. We've had the first bounce, and it's come back exactly the same way. The core is starting to get sticky around the 6%, where the headline, around 4%, and the headline has gone lower. It's almost the same cycle, and this is what all central banks are going to worry about. Now, if we stimulate or we cut rates too early, then demand goes up, inflation goes up, and we go into the second one. And yes, there are some unique cases with 70, but the reason history always repeats itself is because every generation thinks we are better. We always think that, no, I am better, the system is the problem. And, I look at data all the time. History always repeats itself because we're stupid. We always make the same mistakes, we repeat it, and then we're shocked that the same thing happened when we did the same mistake. And maybe that's just me. Jumping across, so the US inflation side. So if you look at the inflation, the lines that we have here, the red lines, the yellow and the green, that's our rate cycle, looking through the data. So when it goes above the red line, they're going to keep hiking, and as they did. When it goes down to the green line, that's when you get the rate cuts. So right now, we have keep close to the yellow line, but everyone's forecasting a substantial amount of rate cuts. I doubt they're going to do rate cuts. Just last night, the Fed came out and said, we're not going to cut in March, then what you're talking about. Now, the reality is that having had 6 to 7 rate cuts in the US for this year alone, I doubt we're going to see anything in the first half of the year. Most likely it will be the second half of the year. And that is only likely to happen once the economy slows down. Because if the economy is doing what it's doing right now, if they cut rates, they will feed inflation, and they don't want to. So this is where the balance is. We actually need weakness before they rate cut. But everyone's already pricing the rate. So, there you go. Now, looking at through the cycle, the Fed fund rate and the bond yields, as you can see, the bond market is very good. It basically tells the Fed what to do. So, as you can see, the 3 lines, the red, yellow, and green, the 2-year, 5-year, 10-year bond yields. And as the bond yields start to flatten, we know that the Fed is already done. So the Fed didn't have to tell us yesterday. The bond market already told us the Fed's done. Now the question is, when do they cut? But funnily enough, everyone will tell you, the Fed cuts, it's good for the economy, things will go up. Actually, the data is completely the opposite. Every time the Fed cuts, the economy slows down, the earnings are under pressure, and the market struggles. So don't be aware what you're wishing for. You actually don't want rate cuts. It's a counterintuitive argument. So I'll give you a classic example. You want to buy a retail stock? When you buy a retail stock? When they're putting up interest rates. Because the only time they put up interest rates is because people are spending too much money. That means retail is doing well. And you never buy a retail stock when it's cheap. Because when it's cheap, everyone knows the stock is doing well. You buy a retail stock, it's a classic cyclicals. You buy a retail stock that looks extremely expensive because nobody wants to touch it. You buy a retail stock when interest rates are going up. The same way, when interest rates are being cut, you sell the retail stock. Because they're cutting because people are not buying it. Which means retail stocks are not going to do that well. So you have to think, you got to put yourself in the other shoe and see, okay, why are they doing that? How is that going to flow onto the earnings? Similarly, the economy is the same thing. The only reason they're cutting rates is because the economy is slowing down, not because the economy is doing well. The interesting part about for me on this one, the Aussie dollar and the bond yield cycle, is the Aussie dollar is a proxy for global growth. So if it's a proxy for global growth, it's a proxy for bond yields. So whenever you see Aussie and US bond yields starting to slide, that's bad news for Aussie dollar. And Aussie dollar sliding means lower growth, which means lower demand for commodities, which that means even lower Aussie dollar. So if you get into that spot, so when bond yields start to slide, which is basically they're cutting rates, and it's not good news. People always, I love it when the media tells you, rates are going down, it's a great news. No, that's not good news. I want rates to go up. That means people are spending. The economy is growing, which is counterintuitive. But yes, that is what the data is. So in reality, when bond yields start to go lower, Aussie dollar will go lower. When Aussie dollar goes down, we are very good at digging stuff up and giving it to other people. Everything that we use, we buy from other countries. So if you think about we're buying everything and Aussie dollar is going lower, it's going to cost more. Even though we have oil, we have gas, we still send it overseas to refine, and we buy it back. Which means whenever the currency goes down, all of our costs go up. So I do not want Aussie dollar to go down. I prefer it to be high. Very just. Now, when you look at market multiples, it can be confusing to a certain extent because there's a lot of moving parts to it. Now, if you look at the US market, it's very hard to judge the earnings because a lot of the companies in the US, the big ones, are global companies. So the nice way to look at it is on a global perspective. So because, you're not going to sell to anyone outside the Earth. Well, until Elon goes to Mars, we're not going to sell to anyone outside. So in that context, if you aggregate all the GDP in the world and look at all the equity markets in the world, and you look at that much, it actually is quite interesting. Because if you look at pre-GFC, the average is around 1.3 and 1.2 market cap to GDP. It's very more because we always believe that things will grow. But as you can see, around the GFC, we got to 2.2 level. It's amazing how much we were paying because we were paying for future growth. So we paid off so much, and the multiple they paid off. So even now, we're actually paying around 1.8 times the GDP of the world for our market caps. So equity markets around the world is 1.8 times the GDP. There's a fair amount of growth being priced into the markets. Now, how does that work? Well, when we got to 2.2, interest rates around the world were pretty much zero. So that's that peak when interest rates are zero. Where we are now, we're at about 15-year high interest rates, and we're at 1.8. And it doesn't make sense. But yeah, that's just me. You just have to work out where's the upside for the overall market. This kind of valuation tells me that's going to be tough. The market overall will be tough. But that doesn't mean there isn't places to be where you can make quite big money. At the end of the day, investing is about making money. It's not about being right or wrong. It's about making money. That's all we care about. Now, the beauty of that is the indexes have particular size. So, for example, in the US, 55% of the NASDAQ is set stocks. And so, if they underperform, you can still make a lot of money. So, it is a matter of being in the right segments of the market. It's going to be important over the next 3 to 5 years. It's not going to be the overall market. The overall market will up and down. It's unlikely to do a lot because the multiples are way too high. And we're at bond yields at, we're looking at 4%, and the market, everyone's worried about 4%. If you look at it over the last 20, 30 years, the average is 4 to 5%. So it's actually where we are is very normal for bond yield, but the market's struggling with that. So if you imagine why it must apply. There's a fair amount of data here. I'll just tell you the main things. So every economy bigger than Australia is not that same. Australia has, let's ignore China and Russia and Japan because they're big entities and they do things differently to everyone else. If you look at the rest of the economies, we actually have higher inflation than everyone else, but we have lower rates. We actually have one of the lowest unemployment rate running around, but we still have a lower rate. The reason is, in Australia, we're built on two bubbles. We either pump property or we pump commodities. There's only two engines, and we basically balance out one after the other. Where we get into trouble is when both those bubbles align, because we haven't got the next one to try and buffer. So China runs our commodity cycle, and vinyl has held up nominally better than anyone expected, despite the property weakness, despite everything. Vinyl has held up really well, which has held up our commodity cycle. Now, our property market, well, whatever multiple you're using, it's expensive. But hey, we haven't got any other engines, so everyone, whether from government to RBA, will do their best to hold it together. So we're in a cycle where you have high commodity prices and high property prices. So you're kind of stuck between a rock and a hard place. So does the RBA actually want to raise rates? Yes. Can they do that? No. Are they going to do that? No. You're going into a political cycle like the US, the Fed, no chance of raising rates, even though they should. They're not going to. So there is the political pressure that plays out. In Australia, the same thing. I don't think they're going to raise anymore. But cutting rates is hard for them because they've got bubbles. They've got everyone spending too much, mostly. The retail numbers, they're still holding up. So, and we jammed up immigration, so that kind of added to the demand cycle. So, things we do to hold things together can also create problems for you. So, yeah, nothing comes for free. There's a cost to doing things, and the government is slightly. The money supply. This is as a very high correlation to market. It's as simple as that. When you put more money into the economy, people spend, ratings go higher, market does well. And as you can see from the red line, the money supply has rolled over. The market is still holding up. So the market is telling you they're going to give more freebies. Now, this is interesting because we're in an election year in the US, and the current incumbent government is behind on the ball. You've got 11 months to the election. It's going to be tough. The Fed is going to potentially cut back up, but they have to hold the economy together. So how are they going to bring money this cycle? Well, I can't see it logically. So there's got to be fiscal handout. Yeah. So the budgets will get a bit more messy. I'm going to show you some numbers. That will be here. So first, on the global manufacturing side, global manufacturing hasn't recovered. So we had that post-pandemic boost that ran up, and around 2021 at the peak, and then it's gone negative. So globally, manufacturing is actually been negative for a long time. It's the longest negative cycle since a dot-com era, 20 plus years ago. And it's still negative. All the major economies, whether you're looking at China, whether you're looking at Japan, whether you're looking at Germany, US, they're all in negative sentiment for manufacturing. So again, we've got not maybe a lot of stuff. So you can't just give money to people to spend because they're going to both pay for the limited kind of things that are being done, and we're going to get inflation. So it's a supply-demand problem. This is China. The PMI side. So the blue line is services PMI. So things like what you spend on restaurants, shopping, blah blah. And then you've got the red line, which is manufacturing. That is China, biggest manufacturer of the world. Yeah, people will tell you they're going to go to India. I mean, these things take. You're not going to flip the switch and suddenly move. So China is still the main dominant player. Their manufacturing is actually in negative sentiment. So that's in contraction mode. Services is barely staying above contraction, so it's holding up. And the Chinese market is in multi-year lows. And everyone tells you, oh, there's stimulus coming from China. Yeah, I think if there's stimulus coming, the Chinese would know it. The Chinese market is unlikely to be at multi-year lows if there's stimulus coming. They cut their reserve ratio for the banks so they can lend out a bit more. They've been doing that for over a decade. They're managing their economy. They've got 1.6 million people. I mean, their rounding area is bigger than the US. So they have to do things a lot faster, earlier. They have to manage things differently. They've done quite well. I'm quite impressed. I mean, I know since I started in finance 30 plus years ago, everyone tells you China's going to blow up, China's going to blow up. Okay, China's not going to blow up. That's fantasy. They will have cycles just like everyone else. They're a huge economy. They have demographic problems. Guess what? Everyone's got it. And people are trying to deal with it differently. China has to deal with it for 1.6 trillion. But it's a slowdown. As you can see, exclude the pandemic crash, GFC, global trend is in decline because China's huge economy grew double digit for so long. It's just a scale game. As you get bigger, you cannot keep growing at that rate. Growth rate naturally will come down. It's just normal. But people expect them to just keep growing at double digit, which is insane. But anyway, that being said, China is important to us because, generally we dig stuff up and give it to China. Yeah, they tell you that, we're going to do that, we're going to give it to India, we're going to give it to Europe. There's no one pays like China. There's no scale. If we go on to that, you can think of, they are the dominant player in the world. It's China or Slovakia. So, but China is not, I'm not worried about China blowing up tomorrow. That's not the case. But the growth rate will not be the dramatic level that we used to. So we have to accept that adjustment. So this is where how much money the Chinese government has gradually put into the economy. So you can see the aggregate 12-month growth rate. Every time things slow down, they pump the economy. But they do it in a nice way. They don't go overboard. They don't get carried away. They do enough to keep things moving, but they can actually get it to a point where they do too much, then they get worn out. So as you can see, the peaks have been lower and lower and lower. Why? Because on their numbers, you can see that they're not going to get much out of it. So it's no point throwing out huge stimulus boosts if it's not going to do anything. And for China, it's actually completely opposite to the rest of the Western world because they are manufacturing giant. For them, they need to keep wages down. So if they have high inflation, then they have to raise wages. Then they become less competitive than manufacturing. So for them, it's actually important to have very low inflation and have very low wage rate and have very low wages, because then the supply chain is very hard to leave. And trust me, it is very hard to leave. Usually, I was in finance at Citi when we tried to outsource to India, and that was in 2004-05, and it sounded like a great idea. For an MBA student in the US, I have a whole team in Mumbai. Sound like a great deal. We set it up, ran it. 6 months later, half of them leave. They go to Goldman Sachs, get 30% pay rise. And then 6 months later, they go to Credit Suisse, get 30% pay rise. Within a year, they come back to us and double the salary. So the cost just blew out after about 2 years, and it becomes useful. The Indians are much more savvy, and you can't control the wage growth in India like you can in China. But China has this structure to keep that, because they can maintain a certain level of living standard and keep wages controlled, which I doubt to see anyone else can do that in a democratic world like India. That's tough. But anyway, people think they can, so we'll see how it plays out. Now, the US budget, love this one. They don't do surplus, right? They just don't do surplus. So, as you can see, all the lights are below. So there's like quite long, like in the last 60 years where they've had surplus. Now, governments don't really need to run surplus. That's beside the point, because you're trying to balance them. But you need to run, it's a secret, like anything, it's a secret, right? There will be periods where you make money, there will be periods you spend money. You can't just spend money. So where we are now, I'm going to throw some numbers here, no big numbers, right? Their debt is 34 trillion. We don't do billions anymore, that's so 1990s. 34 trillion. Their GDP is 26, 27 trillion. So their GDP is, yeah, it's fine. That's, and they're all cutting taxes. So let's see how that comes out. Now, on top of that, they have debt. So their interest payment on their debt is $1 trillion. So every year, it goes up by $1 trillion. Then their forecast, their forecast for the next 10 years to run a deficit somewhere between 1 to 2 trillion a year. Like, doing nothing different. They're going to run 1 to 2 trillion every year for the next 10 years. And that's the base case. So I think it won't be the base case. Usually it's higher. So put that into context. Basically, this inside debt pitch, right? So we've had the pandemic debt. Everyone had that. Everyone had both. But now the new trend is every government runs debt. Whether you are, every country that's having a decent growth rate is based on debt. They're just adding debt. These are not in the billions. We are in the trillion space. I mean, hell, we even got to a trillion debt. It's cool. Now we've said it, we're a trillion debt. It's like Australia. Everyone is a billionaire. They used to show who wants to be a billionaire. Now that's who's cheating. Now, just to make that point, around 2015, the red line went above the blue line. And it's true. My mom keeps telling me that. The red line's gone above the blue line. That's your debt. You see how the debt is taking off. They ain't going to catch it. These revenues go on. So this is about managing growth rates. So do central banks want high interest rates? No. Everyone has gone up in debt to equity. So no one wants high interest rates. But the problem is, why is it high? Because they don't have a choice. So the reality is, cutting interest rates, yes, everyone wants to cut. But can they do it? No, because they'll make it worse and interest rates might go even higher. That's the lesson from the 70s. Guess what? Repeat mistakes. So that's the problem. They are trapped in that. So in that scenario, their debt to GDP over the next decade, potentially, US will become like Japan, over 200% debt to equity. Scary? Yes. Now, this is another way of showing it, what the debt has done in the US economy. So the GDP growth rate is not real, just nominal growth rate. The blue line, they're pulling up pretty good numbers, decent growth. The blue line is when you strip out the debt that's gone in. So if you said, oh yeah, I used to have $1 million, now I've got $2 million. But the extra million was all debt. Well, you didn't really grow, you just borrowed money. Now, if you strip out the debt that they've added, the blue line is your growth rate. So see the blue line is below the 5%, it's about 3%. Guess what the inflation is? 3%. So if you strip out the debt, US actually has no growth. And so you're going to election, guess what they're going to do to keep growth rate? They just have some more games. That's what you can eat. So that's going to be the answer. There is no solution. I mean, they tell you otherwise. They're going to tell you that they're going to cut taxes. They're going to raise taxes. They're going to increase revenue there. They're going to put tariffs there. Guess what? Always do the handouts because it's good for the election. When they have to do the tax rises and tariffs and stuff, they're getting to blockades, doesn't happen. And guess what? It just grows. The problem here is the debt where it is, as it grows, your interest payments are going to keep growing. So it's kind of like a self-satisfying policy. Your debt grows, interest rates are high, your debt's going to go even faster, which means interest rates go even higher. So, welcome to the stupidity of where we are. Now, the US recession cycle. Our model has predicted a slowdown / recession cycle coming in the next 12 months. Now, all the indicators, every time these models go on to 100%, as you can see, previous cycle, all the red bars, recession. Now, why hasn't it happened? Because of what I was showing you before. Nobody ever does debt like we've done in the past. So we're doing phenomenal amount of debt. If I hand out to you phenomenal amount of money, sure, things will keep moving. But at some point, you've got to pay the bills. Someone's got to pay. Now, all we've done is delayed that effect, and the bond market is telling you that. That's why once yields have gone up, everyone told you it's the end of fixed income. Well, the reason fixed income has come out hard is because you can't kind of have zero rates and give everyone cash endlessly. Now, Fed for the US market is interesting. The liquidity is what drives the market. The red line is your Fed liquidity. They tell you that they're shrinking the balance sheet. The data will tell you otherwise. For the last year and a half, the liquidity has pretty much been sustained because they have multiple levers. So they cut the headline numbers. So yeah, the balance sheet is coming down. And then they reverse repo, push money into the banking system, this account, that handout, this handout. They've got multiple levers to play. So when you average it out, and the aggregate number has not gone down since early 2022. So yeah, they're shrinking the balance sheet, but they're funding the numbers on the other side. But you can see how the market is very correlated to the liquidity. Till 2023, when we have dreams are cheap, let's have AI. Yes, everyone in the market told me about AI. I spent 30 years fintech working on AI type technologies. So people who do not understand that are telling me how AI is going to change the world. It's been changing the world for 10 years. We just don't know. The next 10 years, it will change the world. But it's not going to be something suddenly goes, someone does catering and suddenly AI is going to change that. No. I mean, certain industries will be affected by that. We're already doing a lot of technology. So we like stocks who use those technologies because they're much more efficient. They're able to react how things are changing right now. So those are the businesses you want to be smart people. Now, those kind of industries already use some AI. They will take the next lead. But for the average person, yeah, you're going to see ChatGPT on your Microsoft Word. Doesn't mean suddenly you're going to be making billions more. No. Is Microsoft suddenly going to charge you more? No, because the whole idea behind it is to keep record. Now, it's like a drug thing. If you have a free sample, you get hooked on the drug, keep people off. So the technology guys will do a lot more. Yeah. And it's not going to change dramatically. So the market initially ran up on that. And then you had that pullback in the market in around November. And then suddenly you had November and December, a huge run up. And everyone was huge. Where does the money come from for this kind of run? Well, it was basically everyone left China. So China, after some 20 odd years, first one, all the global funds pull money out of China and to go somewhere else as an allocation. They go to markets where they can artificially fund the stocks. So if you put that money in the US, you put it into 7 stocks, you can actually move the index. In Australia, you need to pick 3 stocks, move the index. EHB, 10% of the index. CSL, CPF. It goes up. even if the rest of them are not doing anything, just go to buy 3 stocks at a global level and you push up our market. Right? So, interesting cycle, US market, huge run. Now, even the Fed managing the liquidity can't support that. So, we are in a situation where, yes, there are certain thematics that are playing, but everyone is in that. And when the big boys decide to leave, you better not be there. So if you're playing that thematic, that's what is happening. You're in it, massively proud of it. Showing the inflation side. The blue line is the Chinese inflation. The red line is the US inflation. What is interesting here is that the Chinese are at pretty much deflation, which works for them. I know everyone else thinks, oh, it's bad. Actually, it works for China quite well. Right? But eventually, you'll get people will stimulate. Eventually, you'll get growth rate pick up, and China goes up. And at the end of the day, yes, people think that US does a lot of manufacturing. Yes, they do. Germans do a lot of manufacturing. Yes, they do. But a lot of those parts that they put together with are made in China. So China will start to swing. Once China starts to run, every time China runs from inflation territory, guess what happens to US inflation? It goes up because what your input costs are coming out of China. So if China goes up in inflation, the world goes up in inflation. Well, that's our beautiful supply chains. The US economy, very strong, has been held down, deflated, and that's done really well. The employment market is only well over the last couple of years, despite slowing economy. Well, in real terms. The blue line is your temporary service workers. So this is your margin workers, the cheaper workers that they would hire and fire quite quickly. And it tells you a classic cycle of what's happening in the real economy. Now, the unemployment stays low till it doesn't. So the red line, it's very general, it doesn't really go up over a long period of time. It goes up fast once it starts to go. But what happens in the blue line is important because that tells you on the margins what the economy is doing. So, as you can see, every time the unemployment rate started to take off, the blue line started to move down first. And guess what's happening right now? We're like getting rid of all the temporary stuff, So what they're doing is, yes, it's a tight labor market, hard to get good workers. So in an environment where things are slowing down, they're getting rid of the cheaper workers and they're keeping the good guys because they want to lose them. Until things get tough, then the cycle. And what history tells you is that's when unemployment rate comes. I'm not saying it's going to pop, but it's just North American freight. If the economy is doing so well, you're not getting so much freight going through North America. US is the biggest economy in the world, it's the biggest market in the world. The freight is negative. So we're missing something. There's not enough stuff. If they stimulate, prices will go. You need to get more stuff before you can stimulate. That means China has to be doing more stuff, which they're not doing it yet. Now, on the economy. Interesting thematic. The blue line is your GDP growth rate. The red line is your GDP per capita. Now, that always leads the cycle. So, our latest, policy adjustment was we'll get more people in, they will drive demand, and it works. Sure. The only problem is, once you do that, they do the consumption, they will then have to live there. They have to buy the same things. So they're going to push up inflation. Things are slowing down, you've got more people, so it's going faster. So, on a GDP per capita basis, we've already had 2 negative quarters. So in theory, we're already in recession on a per capita basis. That leads the cycle. I'm not saying Australia is going into recession. If Australia goes into recession, I'm worried for the rest of the world, because we're actually pretty good. I was working in the US for GFC. It was ugly. You would not believe how ugly the US was. I mean, our head office was Chicago, and you could buy nearly half of Chicago, and houses for like 2 months. Or bankrupt, you had to pay their loan together. This is how things get going. I came back to Australia, okay? Nobody actually even knows there's a GFC. I had to explain to people what a GFC is. That's how bad it is. We were we were managed really, really well. Really well. And so, I mean, the government of the day did not get the credit, but I got relatives in Europe. I traveled around the world at that time. My sister was working in the UK. She was working for AFE, and we're one of the places where it went down first. Lehman Brothers. I was actually teaching to London Stock Exchange when Lehman Brothers went down. I was doing a presentation like this, and I saw the car open, and a guy comes out of the building, pushing a chair with a box in it, threw the whole thing in the back of the car and drove off. And then people kept on coming out of the room. And then we found out that's Lehman Brothers. But yeah, that's where GFC started. Then that's what happened in the US, Europe, in Australia. You know, we didn't even catch a call. I mean, we did not even, nobody understood what kind of mess we missed. And it's amazing. And so that's why you look at the GDP growth rate, since the 90s, and maybe I'm old enough to remember what happened in the 90s. I went through all of those .com, the 90s, enterprise, all these. We haven't had any growth rates. And we just have it. So in Australia, we have no experience dealing with real economic slowdown. Not for decades and decades. The yellow line is one of the key things to keep an eye on. It's the savings rate. People are borrowing money to the nth level and they're burning their savings money. It's been dramatic. It's now lower than pre-GFC. Now, once it's that's as of September, India's dollar will come out soon on what happened in the last quarter. If the trend remains, we will start to go negative in 2023 in savings. And that's going to be interesting for consumers because the economy has gone up around the world quite well, mainly because handouts and savings rates fed the retail business, and that's been probably holding up. Now, once that goes negative, we get back to the same thing. Can we get a handout? And if you don't get a handout, well, it's going to get tougher for retail. This is where it's tricky. Now, if you do a handout, you feed the inflation, or feed the inflation. We have a revenue, we have property level, quality level, we don't control the quality level, control the property level. If rates don't go up, that's not good. So, nobody wants inflation. That's the goal. We're running out of appreciated trophy. So, take a check. Now, in the US market, we've got price analysis is a really nice way to see what people are buying and for what. So, the best performing factor, just buy the biggest company you find. There's no talent to it. Basically, for the whole 12 months, buy the reports. It's the text. Buy the text, you buy the text. Did any fund manager do that? No, because no risk management is going to allow you to hold four or five stocks. It just doesn't work like that. So every fund manager has a struggle in his environment because it's a bunch of large caps out for you. Everyone else is not doing that. So the biggest factor is the size. Should we be doing that? Well, not really, because everyone's already there. When they want to get out, you don't want to just buy pain for it, buy the pain for it. So just remember that. Where is the value and the trade line momentum? So it's the next two best performers is value and momentum. Because momentum is starting to peak, because value is starting to peak. So where you want to be, where the main potential is going to look for relative value streams. The stocks that are actually relatively valuable, but they have momentum covered. So if they're in a cycle, recovery cycle, and they're relatively cheap, those are the ones going to go. I'll talk about these sectors again. Again, to reiterate that point of view, growth and value, it's huge. So that tells you what kind of sectors are going to do well in this cycle. So you can look at the red line, that's the global growth value cycle. We had that when money was cheap, growth outperformed. We peaked, and then interest rates went up, we fell, and then we had the tech bubble, and it ran up again. So we got this huge line in the red line, and even the blue line our market is actually fairly good. US is predominantly growth oriented. Our market is predominantly value oriented because we have a lot of commodities. So commodities tend to make it a lot more value. So that's why global investors tend to look at US markets and Aussie markets just to balance out the bank. So, in that scenario, ours is starting to turn already. So value is starting to outperform. Growth has started to peak. And I suspect we're going to get the same thing. So what our growth value cycle model is telling us is we should be concentrating on value swaps on the recovery cycle rather than just chasing growth strength. Because the pure growth from everyone's looking the primary trend. And as it starts to underperform, then get out, you will be paying for it. And in the commodities guys, everyone's got their favorite commodity. Everyone is in love with this commodity. And logic becomes irrelevant because it's a thing, right? It's short in supply. Just about every commodity that's hot, and you see an article on CNBC here, there's a supply shortage, generally means that it's full. Because if you actually think there's a commodity shortage, you're not going to put it on CNBC. So anyone who puts an article that there's a particular commodity shortage, it's definitely not. Copper and gold is important because everything we do has copper. Radio bill, construction, infrastructure, EV, it doesn't matter what, you need copper. For that last year and a bit, copper continues to underperform gold. If copper is underperforming, people are not doing so. I don't care what you're buying to. If you're in a growth commodity, if you ain't using copper, you ain't going up. So if you only the commodity is going up, it does not matter if you call the best thing under the sun. It's not going to make money and no one's going to. Yeah, it's like a race. You're running in the jungle and trying to chase a mountain. You don't have to be the fastest one. You just got to be faster than the fastest person there. Because the driver will take the first spot. So the trick here is, if the commodity is running, you're in the right track. If the commodity is not running, it doesn't matter if you're in the best. So you're pulling into the commodity, just keep the cycle where that commodity is running, then move forward options. Just to give you a perspective, there's only a few commodities doing well. Uranium, iron ore, gold. I can't work out iron ore. And steel as well is going around, feeding into the steel, iron ore. Again, I cannot work out how that works in China. The amount of related data, the Chinese related data are very good at telling you what happened. So what they're telling you is that they're building iron ore has been strong, but I wouldn't be chasing iron ore. Uranium, maybe not uranium for a while, it's had a huge market. It's outperformed even oil and coal, which I'm surprised about, but it is what it is. You can see from every other commodity has underperformed. Everyone told me what last year, commodities is basically said, they're all underperformed. Alright? You have people, you're not able to compete. It's underperformed. Why? By the truckload. Who wants it? So just be aware whether you are in the cycle and what's doing well. Third graph has a scatter plot to give you an idea. Uranium is the only one standing out of the back. Everyone else is in the back. Gold is at the top end of the back. For me, gold is an interesting one because it's not a crowd. Nobody believes in gold. No one ever believes in gold. But gold is good in a one way of trying to risk your market. Gold is your what people say. It's evidence currency risk, it's evidence systematic risk. We like gold. Especially like Aussie gold miners. The reason we like Aussie gold miners is because when the economy gets into trouble, some of the African countries tend to lose their mines. Literally the mines get taken away. So you don't have that risk in Australia. Aussie gold miners, the other good thing is they pay their cost in Aussie gold. So they put their Aussie price in Aussie gold. So on Aussie gold return, spot gold is 3,100. Most of it, you also pay cost is about 2,000. So they're making $1,000 a ton. Good margin, and they might have debt. They'll pay off the debt, and they have to lose their mine, and they will make that product up. Yes, miners are very risky. The quantities are very choppy. I want to take one more opportunity, but I might try gold. Okay. What these sectors, against US sectors, every sector over the last 20 years has underperformed except one. One sector that outperformed US sector for our part is healthcare. We have phenomenally good healthcare. We have the healthcare stocks that are global dominating, whether it's CSL, whether it's Cochlear, whether it's Resonant, whether it's Vision Vital, there are 10, and I've got other people coming out. I love Biotech, but that's not perfect. But CSL has a massive Wi-Fi. But that is the reason why we started to outperform around 2050 is everyone started to do stimulus. So the growth sector got a lot. So that's why our biggest growth sector is healthcare. And you always wonder why healthcare stocks do well. It's because of that. That is our basically the reward choice for growth is healthcare. So the thing to remember about that also is market is already excited. Like CSL going down to 230. Now it's almost $300, right? I would buy here. We go down to $1. We did the same with Brickworks. We go down at 22, it's now 28, we go down. We're happy to take money to leave. Leave some on the table for the next one. Because all of it, when renters will be up from $35 back to $24. Because remember, with the COVID period, resident listed free, the earnings the last couple of years are nowhere near what it was before. So you have to keep those things in mind. And healthcare sector, when it's cheap, just back up the top and go. Because healthcare stocks, our ones, the big ones, they dominate the world. But they're not cheap over it. But even the great CSL, every 2 to 3 years, will give you a 30-40% pullback. Sector cycles, one of my favorite is the development mining services. Mining services, basically, the problem was they write contracts, and you know how I said people don't learn from the past? Yeah, we don't learn from the past. So mining services wrote contracts where they basically lock in their costs. So guess what? Inflation costs go up, mining services might be gift. So they all go, no, nobody wanted to touch it. But what is interesting is, as they cycle their contracts get better, margins improve, and they turn around. Now, you don't chase everyone, you have to wait for the right one and do the work. So we do a number of mining services, professional services companies, of course, we had a good one, so Proteomics, service stream, the RNA, these are ugly businesses. When it goes wrong, these are ugly. But as I said before, they were cheap, and they're recovering some margin expansion, better confidence. They recover, and they're performing sector. So this is where you have to kind of look at multiple dimensions to the investment side. You've got to work out where things are, who's doing better, who's still got value. When people say, let's you pay whatever price for a growth stock. Yes, we do, then interest rates are zero. No, you don't, then interest rates are high. So we are not at zero. We're not going to, unless there's a pandemic. There's some sectors just to show how things are going to be everywhere. U.S. housing construction sector. It is now more than double what it was pre-pandemic. Right? Those stocks are 40% higher than it was during the pandemic rebound, where interest rates were zero. So someone's telling me that I want to pay 40% higher when interest rates have gone from 0 to 5%. Mortgage rates are higher, which are inflation is 20-30%. So, and this is the other thing that we can tell you, and economists and central banks love to say inflation is good. And that is correct. Technically, that's good. Why? Because it's just a matter of time. If prices go up, and then prices stay up, inflation can go to zero. It actually doesn't matter to the economy, because at the economic level, you and I do not spend inflation. We spend cost of living, pay for stuff. So, if you're buying a coffee, you're paying $5, which used to be $3. If inflation is zero, you're still paying $5. It doesn't come down. So the reality is, around the world, inflation is flying down, but the prices are 50% higher on average around the world for everyone. You can't do that. Alright? And interest rates are going up to 5%. So the spending capacity is dramatically reduced. But the economists would say inflation is down. It's fine. Let's cut rates. Actually, that's why central banks are not cutting rates. It's not. Because cost of living is still high. As you see, so someone will say property prices, construction companies are now paying twice as much as what they used to make pre-pandemic. It's kind of hard to believe that that's sustainable. Now, I'm a massive fan of James Harding. Right? James Harding makes money in a recession. Can't see that much. All construction. James Harding makes money in a recession. James Harding is extremely expensive. Right? Because everyone knows it and they pay up for it. Even in a recession, they make money. But they're paying, like it's a growth stock. Right? You have to differentiate between what is a growth stock and what is a cyclical stock. A cyclical stock can go up and down like a yo-yo. You're on the wrong side. So James Harding is not only good because if you buy cheap, sure, you buy cheap, it's up and down, cyclical, you don't get. But it's not a dividend stock. You're buying it for growth. So when the cycle turns, there is no shame in selling stock. It's not like a great money smart. You can go back. It's not a bad thing. It's not that bad. Food. I love my food. I love food. Food prices from pre-pandemic is up nearly 50%. It's come off the peak. It was nearly 100%. It's come off the peak, but it's still up 50%. If you look at what is happening around the world, geopolitics, war, supply side issues, trade costs, weather issues, political, to the point where India has banned people exporting rice. Afterward it's rice all the time, and they actually banned exporting. Why? Because they got too high inflation. Because of an election coming, they wanted to keep the prices down for the election. So the Prime Minister banned the export of rice. So the rice will be more in India, it will inflate the price and it will make it cheaper, which made everyone else's food costs going up. So everyone is doing their own advantage, which creates a supply problem. So the food is massive for me because whether you delete climate change or not, side issue. The erratic nature of weather is otherwise. It's going to be more erratic, which means using food is going to be tougher. There's land, then calories will be shrinking around the world, so that's going to be tougher. So food thematic is big, still making good markets. In Australia, you buy elders. I took a bit of slack because I was doing elders and went down because of two reasons. Elders went down because the CEO was angry and we were going to have this transition quite rare. On the left, you've got the cattle prices collapsed. It's now really doubled. On the right, the land prices collapsed. It's down. Bottom out September to November, and it bounced it. Guess what? Because all my farmer contacts told me, everyone, when their water was going to pot, everyone told on their health. And they sold it to me, because they didn't want to pay the high fee. The only problem was, we kept on getting rain, which meant plenty of fee, they didn't need it. And then when they all tried to go back and collect it down to rebuild it, well, you can't, because the big guys were smart. They had storage, so they held on to their stuff. The small guys were jumping. All the small guys are trying to buy from the big guys, and all prices are flying right back up. Elders are doing really well, and they managed to use the CEO. They're trading more money, as usual. And so elders got down to $6. From memory, $6 is now getting $9, so it's up 50%. I love cyclicals, and I love it even better when the market thinks of it, because that's where the upside is. Even now the market will not believe in elders cycle. I would suggest that in the next couple of months before we get an upgrade, because it's still raining. Farmers will be like, well, if it's an upgrade, elders will be up. I'm not saying you want to chase elders now, but what I'm saying is that is the kind of thematic that's want to look at. Market is one look at, and food is a great thematic. So people don't believe you can make a lot of money in food. You can make in 3-4 months to make 50%. Okay, so we have a service. What we do, we provide clients with macro research. We do everything from asset allocation to sector selection, showing where they should be, where they shouldn't be, as well as we do numerous model portfolios. So basically, my model of what I do for business is we get each resident their own funding. Everyone in Australia, we have a huge population of self-managed funds, and everyone thinks that. And as I've shown you the data before, for that 40 years, yes, Japan, basically did why the biggest thing went up in profits, right? And that's not using it. Now, it gets tricky. You have to actively manage your portfolio. So what we offer is we offer numerous model portfolios, different size categories, fitting different risk return profiles for clients. And they can follow one model to another model. You hold on to your money, you trade. We are not incentivized by the rate, more transaction or less transaction. We already manage. We provide consistent analytical service, and everyone manages it. You don't know what to do. You don't really care, because in reality, it is your money. It's your responsibility. You want people to do this one, understand why they do this, what risk that they're taking, and then they can make better decisions. We've had an industry in Australia where fund managers make a lot of money basically tugging on a market, they flush them, and I'll have to say to all them, working with people. They're not that smart. They had one thing going for them, is that falling companies. That's not, guess what? Every fund manager is struggling. And because you don't get the free kick, that's what's going to happen in the next 10 years. So, what we are offering constantly, you don't need to pay the big fee and get mediocre return. You can manage it yourself and get decent return. That's our large cap. 10 stock equally weighted, nothing free. That's our small cap. Yes, it's a higher risk, higher return. So you manage what you want. And everyone talks about yield. This is what we call our Gary model. So our view of yield investing is broad at reasonable yield. You never buy yield stocks purely because they're yield stocks. You never buy yield stocks because it's value. If you buy value yield stocks, you're buying value trap because they are in value. You get a yield, you don't lose money on what you invest in. So what we look at here is we look at companies that actually grow at a decent level and still pay a decent amount. Might not be a hundred, but it does work. So our model delivers you core returns, getting actual returns. So none of these performances include dividends. Because we look at dividends and say, okay, you're gonna have some transaction costs. And you're gonna have a few other costs. So let's ignore the dividend, just look at it on a price basis. That's what. So ours is a very risk-averse approach. We're managing risk, market retention. So that allows us to review a lot of different portfolios. People pick and choose one, depending on their risk return profile, and that's your assumption. So that kind of, I guess, covers. I have hundreds of jobs. As you can imagine, I'm a very boring guy. I have a lot of data, thousands of charts. Spend all my weekends looking at numbers and data, so I can go on. But that's pretty much the numbers and all the areas I want to cover. We'll have Q&A later and so forth, and I'm happy to answer questions. But hopefully that was educational and found it interesting.